We got the Inflation Reduction Act, and as I think many studies have corroborated, the initial University of Pennsylvania analysis was that it would not reduce inflation per se. And yet we probably will see lower inflation. So, I think that the administration will take the credit for that. And frankly, all I care about is that inflation unwinds. But to understand the pro-cyclical nature of this policy, taxes will go up. Now, this is over a 10-year period by $737 billion, and spending will go up by $437 billion, thereby reducing the deficit. Now, if that were correct, and I don't think it will be, these numbers are never really correct, but if that were correct, the deficit would be shrinking. And we do know that federal outlays still are down 15% year over year. So that gets into our GDP accounts, and government accounts for 20% of our GDP. So down 15% in 20% of the economy, that is fiscal drag, and is contributing to the recession we believe we're in. On monetary policy, so Chairman Powell gave his annual presentation at Jackson Hole, or gave the Fed's annual presentation. And we read line by line what he said, and it was very interesting. He invoked the name of Volcker, former Federal Reserve Chairman Volcker, who really combated the inflation of the late 70s and early 80s. He invoked his name twice. But he also hinted by using the phrase, keep at it. So that was really a reference to the late 70s, early 80s. And I really do believe that the Fed believes that we have a problem that might be that significant. If they didn't believe it, they wouldn't be acting this quickly. And I think they're awfully afraid of ruining their own legacies. They do not want to be known as the Federal Reserve members who presided over another big wave of inflation. And as we've been saying for quite some time, we think this inflation is more associated with the shock of COVID and the rebound and all of the distortions that took place because of it. And we're getting more and more evidence about that. Now, one of the things that concerns us is because they are so fearful, the Fed members have taken the Fed funds rate up from 25 basis points, so 0.25%, to 250 basis points, 2.5%, in the span of a half year. That's a tenfold increase. Now, we were in a period, especially after 08-09, where the Fed was, basically laying low and just letting the economy heal. And so we had this extended period of very low interest rates, which started to change in 2017-18. And then they had to rein it back in because at the end of 2018, the economy looked like it was going to fall apart. And then, of course, in 2020, we had COVID. Nonetheless, for most of the last decade, very low interest rates, very little movement in interest rates, and now all of a sudden, a tenfold increase in short-term interest rates. Many people are using the level of interest rates to suggest that this is not really tight monetary policy. It's only 2.5% on the interest rate. But I really believe that change has been a tremendous shock to our system and certainly to housing. We're seeing statistics, and I'll go into them in a moment, all over the place, that housing is in a recession. And I do believe we're seeing evidence that prices are going to follow. So we're concerned that the Fed's overdoing it, and that in invoking Volcker's name twice, that Chairman Powell was basically going to say, we're keeping at it, and we almost don't care what happens to the economy. And in the statement, it was very interesting. There was no focus on real economic activity. The only focus was on inflation. So that was a clear message. We don't care. We just want 2% inflation. Now, the reason this is so important from an investor's point of view is if you look at valuation, so PE ratios in the 70s and early 80s, I think they bottomed out somewhere between the 6 and 7 times range. So 6 or 7 times earnings. That was because inflation had been ingrained, and the discount rates, we were at a double-digit interest rate, so valuations should have been that low. Now, many people believe, certainly the bears do, that we are back in a 70s environment. And that is why they're very negative on the equity market. Because today, the PE ratio of the S&P 500, assuming $200 for S&P earnings this year, and I actually think that's too aggressive, but that's close to the consensus estimate. The S&P 500 is selling closer to 20 times. So many people who are seeing another big drop in the market are focused on valuation and that metric. And yet the bond market does not agree with this at all. In the 70s, bond yields just kept going up inexorably. And that is not happening now. If you look at the 10-year Treasury bond yield, it is having trouble getting above and then staying above 3%. We dropped to 2.5%, for example, in August. And now with the Fed's latest rhetoric, and especially Chairman Powell's Jackson Hole presentation, the bond market has back up into the threes. But we don't think it's going to stay there. And I think that most of the people who believe we're going back into a 70s environment think that interest rates are going to double and then double again from there. If they do not, if these interest rates do not continue to move up, and we do not think they will, the long-term Treasury rate, I'm not talking about the short-term, that's more governed by the Fed policy directly. The long-term inflation rate is more focused on the next 10 years growth and inflation outlook. And so far it's saying that anyone thinking we're back in the 70s is wrong. And I think a lot of price indicators are beginning to corroborate that. The reason we worry about the Fed making a mistake is it seems to be focused on lagging indicators. Now, employment is one, but I think in the Jackson Hole speech that basically Chairman Powell said he didn't really care what happened to the real economy, and that would be employment. But the PCE deflator, so the PCE deflator that the Fed uses is the core PCE deflator, taking out food and energy, which are sometimes held hostage to supply shocks, like we have seen.